Good evening, everyone, and welcome to our Budget Simplified session this Thursday evening. We hope you've all had a nice week over the last 2, 3 days, and welcome to our take on what the budget is about today. We had our finance minister table the budget, 2 days back, and we have our take on this. So, this is the key highlights that we would like to share with our viewers and our clients who've logged in. Welcome to the session today. So the budget highlights from our side are as follows. There's been an increase in the standard deduction exemption limit for the salaried class and pensioners. There's been some change in the tax slabs on the income tax regimes. There's been changes in the capital gains rules. They have rationalized the long-term capital gains across different asset classes. Basically, all of them have been brought to the same bottom line. There's been a change in the customs duties on gold and silver, which has been reduced from 15% to 6%. And the indexation benefit on the real estate sales proceeds has been removed, and the capital gains percentage on the tax has been lowered. So we come down to the new income tax slabs that have been put in place. This is with respect to the new regime. We're sharing an example because it becomes easier to understand that when you have numbers in front of you. So we've shown the taxation implications for someone who's in the 25 lakhs annual taxable salary. So the previous year is March 23 to April 23 to March 24. The current year is April 24 to March 25. So the tax rates for the previous year was under the 0 to 3 lakhs band, there was no tax. And that remains the same in the new regime as of now. The old slab was 3 to 6 lakhs as the second layer, where you were taxed at 5%. And that slab has been changed to 3 to 7 lakhs. And there you will, for that band, the tax is at 5%. So that would be 20,000. The next band was 6 to 9 lakhs, where the tax was 10%. And that band has been changed to 7 to 10 lakhs and stays at 10%. So there's been some tweaking in the slabs, and we'll show you the net result as we go ahead. The next slab in the new regime was 9 to 12 lakhs, taxed at 15%. So the tax there would be 45,000. Now the slab is 10 to 12 lakhs at 15%. So net, when you look at the first three slabs, you were taxed till 15% and up to 12 lakhs, and you paid about 90,000 tax. Now that has been rationalized such that up to 12 lakhs, you pay only 80,000 of taxes. There's been a 10,000 reduction here. The next slab and over stays the same, 12 to 15 lakhs at 20% and over 15 lakhs at 30%. So for someone who was in the 25 lakh bracket earlier, the total tax was 4,50,000 and cess additional of 18,000, which made it 4,68,000. While now for someone in that same 25 lakhs, the tax outlay was 4,40,000, so 10,000 less. So it also reduces the cess by another 400. So the total difference in the tax payable for someone with a salary of 25 lakhs comes to 10,400 rupees. Now, we haven't taken into account any exemptions here. We just calculated how it would make a difference because of the change of slabs. So net 10,400 rupees is lower tax on the new tax regime. There have been some additional tax savings for the salaried individual. For a salaried person, there has been an increase in the standard deduction, which was previously at 50,000 per annum. It's now been increased to 75,000 per annum. But this is not applicable for other income categories such as business and self-employed. So this gives an additional tax relief of 7,800 rupees. rupees, which is basically the 25,000 increase into the net tax that you pay, which is about 31.2%, in case your income is above 15 lakhs. So along with the previous 10,400 and the now 7,800, a salaried individual who's earning above 15 lakhs will pay about 18,200 rupees lesser in. Have there been any changes in the housing loan benefits? No. Have there been any changes for senior citizens? Nothing more than additional to what was existing. Have there been any benefits, especially for women? Nothing more than what was there previously. Or we now come down to the tax exemption deduction comparison for a salaried person between the old and the new. Because there are still some people who feel that the tax saving benefits that I get under the old scheme are a better off option. We are giving you a comparison here. If your income level is at up to 5 lakhs, you could go with either of the regimes because you're not liable to pay any tax over here. If your income is 6 lakhs, then if you are claiming an exemption of only 1 lakh, it wouldn't make a difference between old or the new. For the old regime to be more beneficial to you, you need to have a deduction claim of more than 1 lakh. If you cannot claim for deduction of more than 1 lakh, please move to the new regime. If you have 8 lakhs as income, you should be able to claim a deduction of more than 2,50,000. Else, please go with the new regime. If you have a 10 lakh income, you should have an exemption of more than 3,50,000. Else, please opt for the new regime. If your income is 12 lakhs, you should be able to claim more than 4,18,750 to make sense to stay with the old regime exemptions. Else, please go to the new. If your income is 15 lakhs and above, you have to be able to prove you have exemptions of about 4,58,000. Else, please go to the new regime. If your income is above 15 lakhs and 75,000 and up to 5 crores, you need to have an exemption of about 4,83,333 to make a difference of between the old and new. Else, please stay with the new regime. And a blanket, if you're above in the 5 crores and above slab, then you stay only with the new regime. Now, in this deduction, we are assuming a total across all these that you can claim. The standard deduction for the old regime, which is 50,000, deductions under 80C, which is 1,50,000 across the various instruments that you have, which is your EPF, PPF, LIC, tax saving mutual fund, Sukanya Samriddhi, everything together. Then you have 80D, which is health insurance premium, 25,000 for yourself and family. And if you have senior citizen parents, then additional 50,000. A home loan interest up to 2 lakhs. If you have an education loan, then whatever you're paying back there. And your self-contribution to NPS, which is 50,000. So if you put all of these together and can total to these and more for these slabs, only then opt for the old regime. Else, please stay with the new regime. There have been some changes in the capital gains taxes. The idea was to simplify the capital gain structure. Currently, it is very complicated with every asset having a different timeline. Now it has been classified into 2 different timelines. Your capital asset is short term if it's less than 12 months, and long term if it's more than 12 months. That's one asset class. And another asset class is it's short term up to 24 months and long term only after 24 months. The first set of category of assets is stocks and shares, equity mutual funds, listed bonds, REITs, InvIT investments, equity fund of funds, and gold and silver ETFs. All these get categorized into one segment where holding below 12 months is categorized as short-term capital gain. That is, if you sell before completing 12 months, it's a short-term capital gain, and you're taxed at 20%, which was earlier at 15%. Once you've held it for more than 12 months, it's long-term capital gain, which will be taxed at 12.5%, which has gone up from 10%. The next category is gold mutual funds, where again, less than 12 months is categorized as short-term capital gain, but this is taxed at your slab rate, added to your income and taxed at slab. If you hold for more than 12 months, it's long-term capital gains at the same 12%. The next category is real estate, which is physical property. It's categorized as long-term only if you have held it for more than 24 months. If it's less than 24 months, it's short-term capital gain at 20%. If it's more than 24 months, then it's long-term capital gains taxed at 15%. There has been some more change on the capital gains rule for real estate, which we will look into in the next sheet. The next category is overseas fund of funds. These are fund of funds which invest in overseas equity. Then you have physical gold, which is gold biscuit or gold jewelry. You have unlisted stocks, and then you have foreign equity or debt. These are categorized as short-term if you've held it for less than 24 months and taxed at your slab rate. And they're categorized as long-term capital gains if it's over 24 months and taxed at 12.45%. The last category is debt mutual funds, unlisted bonds, and equity funds that mutual funds that hold equity that is less than the classification for equity mutual fund. So these are always taxed at slab rate irrespective of the time of holding. So whether it is short, long, 12 months, 24 months, or 36 months, profit is added to your income and taxed at slab rate. All these are rules applicable from yesterday. Any sale that was done before 22nd of July for this financial year will be subject to the earlier rules. When we say short STCG, it's short-term capital gains, and LTCG means long-term capital gains. Now, like I said, there's been a certain change in the way the capital gains will be calculated on real estate. So earlier, when you sold real estate, you had the option to index the price of the property. So you purchased the property for 50 lakhs in a particular year, and then you sold it for 70 lakhs a few years later. But between that 50 lakhs and 70 lakhs, suppose there were 3 or 4 years time, you had the option of indexing the cost, that is adjusting the cost of the property using the consumer inflation index formula, which said that, okay, I bought property at X price, which is 50 lakhs. 5 years down the line, with the indexation, that property would have a value of about 64 lakhs 80,000. And then I sold the property for 70 lakhs, which means your net capital gain actually got calculated only to the difference between the indexed value and the sale value, which was 5 lakhs. And on this, you paid a 20% tax, which came to about 1,03,600. Now, with the new rule, you do not get this indexation benefit. So it's a straight calculation between what you bought it for and what you sold it for. So your capital gain is calculated as a direct subtraction between this. And you pay not 20%, but you pay 12.5% without that advantage. Yes, you do land up paying an approximate extra of 1,46,000 more on tax. So the net effect of this is now that indexation has been removed for all asset classes, including real estate, tax outflows on sale of real estate would be huge. What would be the implications on the capital gains taxation rules change for equity, stock, and mutual fund? Old rates, you paid 15% for a short-term capital gain of, say, 1 lakh, which means you paid 15,000. For that same 1 lakh profit, you would now pay 20,000 at 20%. So you pay an extra 5,000 on a short-term profit, 1 lakh. On the long-term capital gain view, there is a 1 lakh profit, you paid 10%, which is 10,000. This is beyond the exemption limit. And now for that same 1 lakh profit beyond exemption, you pay 12,500, which is 2,500. The implication of this is that the government wants to discourage investors who do speculative trading. Buy today, sell tomorrow, buy today, sell in 2 months, buy in the morning, sell in the evening. And that has now is going to attract 20% tax on the gains. Similarly, investors who do F&O trading, there's an increase in the security transaction taxes, or STT, that is payable on each transaction, which has been increased from the earlier 0.01 to now 0.02. So the idea is that there should be more serious money that should come into the stock market, that people want to keep invested and benefit from the growth, not put today and take out tomorrow. So what is it that has become cheaper or costlier? There have been certain changes in the duties. So mobiles and accessories, cancer medicine, gold, silver, platinum, solar sets, X-ray machine, leather goods, lithium batteries have all become cheaper. Plastic goods, cigarettes, PVC, ammonium nitrate chemical, and air travel have become more expensive. Additionally, there's been an exemption on the equity investments, where earlier you had an annual exemption of 1 lakh, which has now become 1,25,000. When you sell equity mutual funds or stocks after holding them for a year. There's another benefit that the government has offered, which is a stipend or an incentive up to 15,000 for first-time employees with salaries up to 1 lakh. These are first-time graduates who are entering the job market, graduates or undergraduates who are entering the job market for the first time and stand to benefit from this payment in the year. And these are the ones that have got costly and cheaper. There's one more exemption that has come in, that there's a tax saving that you can do through NPS, which is the employer NPS, not the self-NPS of 50,000, but an employer NPS, which the employer deducts from your salary. Earlier, this exemption was 10% of your annual basic. Now that has been made 14% of your basic for private salaried employees. So earlier, if you had a monthly basic of 25,000 or an annual basic of 3 lakhs, you could contribute 30,000 towards your annual contribution of NPS, and you could save 1,560 rupees. Now that same person earning 3 lakhs can contribute 42,800 and can save about 2,184 additional in tax, which is 600 rupees more. For each slab, this increases. So as you go higher, you tend to add more to your tax save. So if someone is in the 6 lakh basic pay or an annual package, annual basic pay of 72 lakhs, they can contribute 7,20,000 towards annual contribution on NPS and earlier, and can today contribute about 10 lakh and 8,000. And that would make a difference of a saving of about 1,03,334 rupees in additional tax save. So overall, what does the budget opinion look like? It's a budget with a blueprint for India's 25-year vision, India at 100 in 2047. It's a focus on the weaker sections. So as you saw, the benefit of the changes in the tax slabs and the rationalization is more in the weaker and lower income slabs. The focus is on infrastructure investment. When that infrastructure investment happens, the entire economy gets kickstarted. The medium and small and medium enterprises have also been given an incentive to create more jobs and then eventually urban development. So all this is a kickstart towards further economic development from which the better off income earning classes can also benefit. So what does this eventually mean? People like you and me on our personal finance, taxing, spending, gains, losses. Well, we earn income. We pay 30% as direct tax, plus another 4% as cess. What do you do with the remaining? Either you spend it or you invest it. If you spend it, what's the kind of spends that you have? If it's basic spends, like your household groceries, services, and other things, we pay a GST of 12%. If it's a fancy spend, we pay 18%. If it's a higher fancy spend, we pay 28% GST. If we invest it, then we are investing it to make money. So if you didn't make money, you book your losses. If you did make money, they want to know whether you made it quickly or you made it slowly. So if it's quickly means it's in less than a year, so you pay 20% tax. If you've held it for a longer time to make that money, you pay 12.5%. For all the losses that you make, you can book it and set it off with future profits for the next 8 years. All in all, it's a budget which we think is for the future, focusing on the lowest and not so well to do sections. And we need to be more prudent about how we look into our investments and manage our tax efficiency. We can now take some questions if there are any. You could type a question in the chat box and we shall take it forward. I shall just go through the PPT in case somebody missed out anything from the start. So these were the highlights. Budget. Increase in standard deduction, change in slabs, capital gains change, some on customs duty, and the indexation benefit on real estate going away, but the capital gains tax being lowered. These are some calculations we shared on how the tax slabs change for you. Additional tax saving for individuals with the reduction on standard deduction. No changes in the housing or senior citizens tax. No change for no women's benefit. We also compared how you should look at the new and old tax regimes. We also looked at the NPS savings based on the new change of 10% to 14% on employer NPS. The changes in capital gains tax as assets are either 12-month or 24 months holding period for long-term capital gain benefit. The real estate, the impact on real estate because of the removal of the indexation benefit. The taxation rules on short-term and long-term gains on mutual funds and equities. Additional benefits of the 1 lakh to 1.25 lakhs as exemption limit on tax. And first-time employee benefits for those joining the workforce. And some items that have become cheaper or costlier because of the change in duties. And the overall opinion of what we can do with our money.
Sujata, thank you for walking us through this. I just have one quick question.
Yes.
How does Happy Investor now, adjust or maintain our portfolio considering the changes that are there, especially the capital gain taxes, right? So will
Right.
there be adjustments done to our portfolio or
See, like
based on
we've
rules?
like we've always said, the capital gains tax comes into play only when you withdraw.
Right.
So the long-term portfolio currently is not impacted in any reason. And as per the short term, yes, there is an increase in the tax outflow. But like always, we've tried to rationalize, the amount of tax that you would pay out and we choose instruments that would give you the lesser tax option. That endeavor will continue, and we will relook and see that what we need to realign basis that. And we will reach out to you if there needs to be any realignment. We are very cognizant of the fact that we have to ensure that eventually it is our customer, our investor who would be impacted. So we need to look into that.
Okay, thank you.
Okay, Deepashri has another question. Is it still to continue with the NPS or make an exit? Should we have to invest more on gold funds? It is reduced to 6%. Investing in gold, you're always open to investing in gold. It's a part of the portfolio, but we do keep it at a level where we don't increase it too much. So you're open to do that. The other part of your portfolio, if you have a corporate NPS, please opt for it. Gives you an additional benefit. If you have a personal NPS, yes, you can continue, but you have to be mindful about the fact that you have to hold it till you're 60. And at 60, you only are allowed to withdraw 60% as lump sum, and the balance comes to you as an annuity lifelong.
I did have one other question. One of the slides mentioned that, on the physical gold, there is a tax levied as well. And that
Yes,
depends on, like again, short term and long term.
yes.
So how is that basically verified? I can buy gold, but
True. Sometimes what happens is when you buy gold, you're given a bill, and then when you want to go and change that gold, or you want to, redo it, you go back to the same jeweler.
because
And
gold I can buy from anywhere, sell anywhere. I can maybe sell
true,
my
true, it
jewelry.
is true. This is as per the, what happens with gold when you go to the jeweler. So applicability is largely for paper gold.
Okay. Okay.
Yeah, I have a couple of questions here. Someone says, is NPS saving applicable for the new tax regime also? Yes, only that part of NPS is applicable for the new tax regime, which is the employer's contribution to NPS, which is what we said that it has been changed from 10% to 14%. The other self part of NPS does not apply to the new tax regime. These are some questions that have come in from uh, our viewers who've logged in on the YouTube channel. They're also asking what happens when you have a loss. Now, when you have a capital loss, it could either be lost because you sold mutual funds when they had gone down, or you sold some equity shares at a loss. You're supposed to enter this into your ITR when you file for that financial year, along with the details of the asset that you sold, the purchase price and the sale price, and therefore the loss. So when you book that loss will reflect in your ITR the next 8 years. So this year, suppose you had a loss of 50,000 and you booked it in your ITR. The next year, when you have a profit of say 2 lakhs, you can adjust that with this 50,000 of loss that you have booked. So that's why it's important to book your losses. If you do not book, then you cannot adjust. Okay. Do we have any other questions? Thank you, viewers, for logging in this evening on a busy Thursday afternoon. And we hope you had a good time. And if you have any clarifications, any questions, you can always reach out to Happy Investor. Thank you so much and have a good weekend ahead.